Welcome to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, Oracle shares surging on its strong outlook. More on those results ahead. Plus, wholesale inflation unexpectedly declines. What does that mean for the Fed? And President Trump floats new tariffs on China and India. We'll bring you the latest on trade and much more on Market Catalyst. But first, let's get a check of the markets here because we are seeing a mixed picture this morning. On the one hand, we've got the Dow pulling back a little bit, down about 73 points or so, 70 points, call it, not even a 0.2%. But the S&P 500 is up about 0.5%, pushing to a new record. The Nasdaq Composite also pushing to a new record. It's up about 1/3%. So seeing strength in those areas. We did get that wholesale inflation data out this morning, but it seems to, again, cement the idea that the Federal Reserve will be able to cut rates at its meeting next week. That said, we're not seeing much movement in the bond market because one could argue that outlook is already priced in. In terms of sectors and where we're seeing movement here today, tech definitely the best performing group here because of Oracle. XLK up 2.3%, but energy also performing well, as well as utilities. We got consumer discretionary and communication services that are lagging here today. And looking at the software group, because that's where we find Oracle, those shares are surging 40% at the moment. So just to put this in perspective, I was seeing basically some various size and scopes here of the company, of this move that we're seeing in the shares, that we haven't seen a one-day move in Oracle like this since the 90s. And for a stock and a company of this size, it is highly unusual to see this kind of a one-day move. This year-to-date chart just putting in perspective exactly how large the move today is. Now, in terms of a halo effect, we're seeing kind of one, but it's not consistent. SAP, for example, is down 1.5%, but you're seeing other software names that are catching a bid. But generally, we are seeing this give a lift to the market overall. And let's zoom in on Oracle now, because it is surging after giving that robust forecast for its cloud infrastructure business, expecting cloud infrastructure revenue to grow 77% this fiscal year. Joining me now is Jackson Ader, KeyBank Capital Markets Managing Director and Equity Research Analyst, and Anurag Rana, Bloomberg Intelligence Analyst. Guys, it's great to see you. Thanks for being here.
Thanks for having us.
Jackson, I want to start with you because, again, the size of a company like Oracle, having a move like this is fairly unusual to hear the size of forecasts that we got from Oracle as well. Is this sort of an NVIDIA moment for Oracle?
An NVIDIA moment for Oracle. Not sure about an NVIDIA moment for Oracle, but I do think that we need to put not just the stock movement into perspective, but also the actual contractual fundamentals into perspective. Yeah, it's up 40%. That's a ton. It's adding hundreds of billions of dollars of market cap in a single day. But they booked in the last 90 days, or I guess, the 90 days ended last quarter, about 10% more than they had booked in business over the previous 4 full fiscal years. So it is a big stock movement, but it was also a massive bookings quarter, the likes that we have not seen, not just from Oracle, but from any other software vendors.
I guess that's what I mean in terms of it being an NVIDIA moment. In other words, this is a company that's been around for a long time. We all know the name Oracle, but to see it put up these kinds of forecast numbers, as you point out, in terms of the backlog, in terms of the bookings, for a business that is pretty well known and understood, at least we thought, is surprising, right? So Anurag, how are you thinking about this? And did it feel like it came out of left field when we knew they were building this business?
Yeah, we knew they were building this business, but to get this size of an order so early on, I think that is really impressive, largely because there are so many companies out there that don't want to do it in-house. In fact, they don't have the capital to do it in-house. So they are looking for hyperscale cloud providers to help them out. We're not seeing that same backlog growing for Amazon, for example, but Oracle is getting the same chips as, one would argue some of the neo clouds are at this point. So they are in the business of renting out their GPUs, bare metal computing, and I think that's really where a lot of the traction is for people who want to train their models or they want to host their AI applications.
And I guess I want to get to that a little bit in terms of the competition here. Obviously, it's a very competitive field. There's a lot of demand for this type of compute and this type of infrastructure. Jackson, why is Oracle proving itself to be competitive here, versus some of those other names that we watch within the hyperscalers?
I think there are two reasons for this. Number one is a relentless focus on performance, and performance, just a fancy word for speed. And speed in the cloud means lower costs. So I think Larry said on the call last night, if not last night on some other earnings calls, that if they are twice as fast, that means they are half the cost of their competitors. And so this relentless focus on performance is certainly a competitive advantage. The other thing is, you mentioned, Oracle's 50 years old, but their Oracle Cloud Infrastructure, the OCI business, is not 50 years old.
Right.
So this business, and specifically the business that they are building, focusing on GPUs and artificial intelligence training and inference, they are a relatively new competitor. And so in this case, they almost have the benefit of being a disruptor, whereas their competitors like Microsoft or Amazon or Google, they have this, what I call Cloud 1.0, or a CPU-based cloud offering that they also have to manage. And Oracle is basically allowed to go all in on GPUs and AI in a way that their competitors just can't.
And to such an extent, Anurag, I saw a note that you all put out this morning where you posited that Oracle's book of business here could actually end up being larger than Google's?
It's possible down the road, but that's again several years out. You can't take Google's cloud for granted. Frankly, they have extremely high capabilities with their TPUs, as well as a massive install base of applications. So, but at the end of the day, this is going to be whoever gains more market share over the next several years. There is no shortage of demand right now. The big question is, do you have the capital to expand data centers at a pace that can keep up with the next competitor? And who's going to get more NVIDIA chips right now? I think there's a lot of you could say fight going on those fronts.
And Anurag, when you hear that Safra Catz forecast, where they talk about the cloud infrastructure revenue up 77% this year to $18 billion, and then she talks about $32 billion next year, and then $73 billion, and then $144 billion, do those numbers sound credible and realistically achievable to you?
No, it's possible. At the end of the day, if OpenAI keeps on spending that level of money over the next 5 years, it is possible. However, a lot depends on what is the size of, training funding going on the overall space for the next several years. There is a chance that, it's possible that we may not see that level of funding. But as of now, where we are standing, we don't see any sign of slowdown in AI infrastructure demand. Look at the results from CoreWeave or Microsoft. I mean, there is absolutely no shortage at this point.
Jackson, and I want to pick up on that point because, we keep sort of going through these AI sentiment mini cycles, if you will, right? Especially when you're talking about different industries, software key among them, right? Where I think the market has really gone back and forth questioning the utility and monetization opportunity of AI for software companies. So do you think that this is going to be a sustainable, something that's going to benefit Oracle over the longer run?
I do think that this is something that's going to benefit Oracle in the longer run. If we think about the forecast that they put out over the next 4 or 5 years, I mean, remember that the bookings or the remaining performance obligation, that's contracted. Now, contracts can always be amended, but it's not as if they are putting these forecasts out without the backlog sitting on just off their balance sheet is what I would say. So that gives you a little bit of comfort in what they're actually forecasting. Now, in terms of the headwinds that potentially come from artificial intelligence, those headwinds are expected to be felt by application companies. Oracle is in an interesting position, similar to Microsoft, where, yes, they are a cloud infrastructure provider and should benefit from the building and inference of AI models, but they also might be under threat from the application side if AI were to collapse the software application market into almost onto itself. But Oracle has been pretty straightforward about, look, we are going to develop AI and agents and embed them into our applications, and we expect our applications to be enhanced by AI, and our products are going to be better than our competitors. And so our application business, as well as our cloud infrastructure business, should benefit from this AI wave.
We'll see if that flywheel ends up panning out as well. But certainly today, we're seeing it in action. The market believes it. The shares are up 40% right now. Jackson, Anurag, thank you for your perspective. Appreciate it.
Thanks, Julie.
Thank you.
Coming up, why one expert thinks a market melt-up will not necessarily be followed by a meltdown. We'll be right back. Producer prices fell 0.1% in August, while expectations were that inflation would increase. We're still awaiting, of course, Thursday's CPI data to see how consumer prices fared in the month, but a positive signal to investors who are anticipating the Fed will cut rates next week. Ed Yardeni Research President, joining me now to talk more through all of this. Ed, it's great to see you. So, does this wholesale inflation number sort of confirm what we're going to get from the Fed, or do we need to still get the data tomorrow?
I think we still need to wait for the CPI tomorrow, but all signs suggest that we'll get a quarter point cut. I don't see a 50 basis point cut, but it might be discussed at the meeting.
And when you look at the PPI numbers that we got today, how do you square it with the tariffs that have been coming through? How do you think we still manage to see inflation drop in the month?
Well, we actually have seen some impact of the tariffs on inflation. We've seen it in the durable goods inflation rates, particularly for the CPI and the PCED, the deflator that keys off of the PPI and the CPI. So there's certainly evidence that durable goods inflation has been boosted. Meanwhile, services inflation is slowly moderating in some areas, like the rent component, but other areas it's kind of stubbornly stuck. All in all, I think we can still say that inflation is closer to 3% than it is to 2%, even with today's surprisingly negative PPI.
But you think that the Fed can raise, even given that fact, even given the fact that it's closer to 3 than 2?
Yeah, well, I mean, my preference is that they don't, but they're not going to listen to me. It's pretty clear that Jerome Powell at Jackson Hole changed his tune from hawkish to dovish. He went from saying we're in no rush to lower interest rates to basically saying, well, we should possibly consider making a move. And obviously, they've been talking about lowering rates. Meanwhile, the administration's put a lot of pressure on the Fed. We've got at least 2 dissenters on the Fed, and I think we won't have any dissenters at the next meeting. I think they will vote for 25 basis points and maybe put in some hawkish language that, they're still data dependent, and it's not at all obvious that they're going to keep lowering rates, but they'll watch the data.
Well, and speaking of the data, we've been talking about inflation, but obviously we have to bring jobs into the equation as well. How concerned are you about the job, not just the numbers that we got in terms of last month, but of course the benchmark revisions as well, which showed a big decrease?
Right.
I mean, what does that say about the health of the economy?
Well, the labor market's been awfully funky. Obviously, it's been distorted big time by the illegal immigration flows that we had for the past few years, and now it's kind of the reverse of that. Suddenly, illegal immigration has stopped, and deportations have increased. I would say that the data, to me, suggests that we actually have more of a supply problem on the labor side, and even when we had a lot of immigrants coming in, there's a real shortage of skilled workers, and that's where the issues are. And then, of course, there's a lot of technologies now that are helping to displace workers. So I think when you put it all together, we have an economy with still a relatively tight labor market, particularly for skilled workers. The unemployment rate for people over 24 years old remains below 4%. The real problem is for teenagers. Their unemployment rate is 13, 14%. And then for college graduates or people 20 to 24, many of them are finding it very hard to find a job. So I think that what's really happening here is that productivity is making a big comeback, because real GDP has been actually coming in at a fairly solid pace. And I don't see that getting revised downwards. if that's the case, then the downward revision in the employment numbers suggests that we're going to have upward revisions in productivity, and that's a good thing for everybody.
And is it also a good thing for the stock market? I mean, I know you've been a bull for a while here, Ed, and you recently put out a note where you talked about the growth that we've seen in earnings, kind of despite all expectations to the contrary here. So that productivity picture, that would also seem to be potentially good for margins and continue to be good for earnings.
Yeah, that's absolutely correct. I think the earnings data really do belie all these fear mongerings that are going on about the economy being much weaker than we're thinking. Earnings suggest quite the opposite, that the economy is doing just fine, and that productivity is maintaining profit margins, which is really surprising. And so it looks as though companies are absorbing some of these tariff increases. Either the importers are in the United States or the exporters are overseas. And the fact of the matter is that earnings are turning out to be better than expected. I've been among the bulls, and even I'm amazed by the strength of earnings. I thought that the market would, by the end of the year, be discounting $300 a share, which is a very aggressive number. And now I think the market may actually be discounting something higher than that. $300 a share by the end of the year, if that's what the market starts to anticipate for next year, multiply that by 22, which is where the multiple is right now, and you get 6,600, which is basically where we are right now. I mean, I think we're going higher, probably 6,800, and that would be with a earnings number that turns out to be higher in terms of expectations.
And Ed, why have earnings been so strong, and why have they defied expectations here? Is it all about AI and this? I mean, you look at Oracle today, is it all about that powering things higher?
Well, I think that's part of it. I track earnings for the S&P 500. I look at forward earnings, what analysts' expectations are, and the analysts obviously are keyed in to the company management very closely. And at the same time, I look at S&P 493. I call them the impressive 493. You know, it's not all about the Magnificent Seven and the IT sector that's dominated by them. Other companies are doing well. Look, these IT companies are coming up with tools that enhance productivity, and that's something that can be used by every company. And apparently that's exactly what's happening. So the earnings surprises to the upside aren't just the Magnificent Seven. On the other hand, one has to be realistic here and analyze the market as it is. And what we're seeing is that information technology and communication services account for 40% of the market cap of the S&P 500 and something like 28% of the earnings share. So they are dominating for sure. But all in all, the earnings picture looks pretty bright. And I see the earnings picture actually broadening out to the upside. And that would explain why the market should very well broaden out.
So maybe the impressive 493 will get even more impressive, or maybe we'll upgrade them to another moniker. I don't know. Ed, thank you so much. It's great to see you.
Sure. Thank you.
Take care. We got much more markets action coming up. You're watching Market Catalysts. Now time for some of today's trending tickers. We are watching Vimeo, Rubrik, and Joby. First up, we got Vimeo. The online video platforms agreed to be acquired in a $1.38 billion deal with Bending Spoons. What's Bending Spoons? Well, it's a European mobile app developer. It will purchase Vimeo in an all-cash deal. Bending Spoons had been in talks with banks about financing a potential takeover of Vimeo as far back as March of 2024, according to Bloomberg. Vimeo was spun off from one of Barry Diller's companies in 2021. It has since lost nearly 90% of its market value. The platform has faced stiff competition from rivals like YouTube, which is by far the more dominant force in the online video space. Next up, we got Rubrik, the cybersecurity firm, seeing its biggest intraday drop on record after reporting third quarter earnings results. Rubrik reported a narrower than expected second quarter loss while revenue topped expectations. The stock initially rose after the results, but it's now taken a turn for the worse. And just for context here, when we talk about biggest drop on record, this stock went public in April of 2024 at $32 a share. And finally, we've got Joby and Uber. Uber is going to add Joby's Blade helicopter trips to its ride-hailing app as soon as next year. Customers will be able to book Blade's helicopter and seaplane services directly within the Uber app. Blade's passenger business, which Joby acquired in August, currently operates routes in the New York metropolitan area and Southern Europe via its own consumer app. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, turning now to the latest tariff headlines. The Supreme Court has agreed to fast-track President Trump's tariff case after a federal appeals court ruled that the International Emergency Economic Powers Act, also known as IEEPA, does not authorize Trump to impose sweeping reciprocal tariffs. Meanwhile, the president is urging the EU to impose 100% tariffs on India and China to put more pressure on Russia over its war in Ukraine. That's according to the Financial Times. Joining me now, Ed Mills, Raymond James Managing Director. As always, a lot of tariff headlines to unpack here, Ed. But sort of from the market's perspective, we seem to be looking through the tariffs at this point. When we look at all these tariff headlines, what do you think is sort of most important? How do we sort of pull out from the noise what we really should be paying attention to?
Yeah, Julie, great question. So what I've told folks here at Raymond James all year long is that the president has a lot of different authorities related to tariffs. I don't necessarily think using IEEPA for all of the broad tariffs that he's put on is consistent with the statute, consistent with who controls purse strings under the Constitution. And so what I've told folks is that the process might change. The outcome is likely to be the same. If the president does get struck down on IEEPA, he probably switches over to his authority under the 1974 Trade Act, known as Section 122 authority, a blanket 15% for up to 150 days. He could go back to the Smoot-Hawley Act of 1930 and do a blanket 50% tariff if he wants and restarts this legal process. To me, the biggest question that I get from investors here at Raymond James has been, will these tariffs be refunded? Is there a benefit to those companies that get that refund? And is there an impact to treasury markets? If we're sending out hundreds of billions of dollars back, is that a need to reissue a lot of treasuries? Is there going to be a steepening of the yield curve with an unexpected dump of kind of treasuries coming into the market? To me, that's where I think the market conversation should be focused. And that's where I've been guiding clients here.
And it sounds like you think that's unlikely.
I think clients think it's unlikely. I did a survey last week, got 200 plus client responses, and 20% of them thought that these tariffs are going to be refunded. I'm probably closer to 50% here, Julie. So wow. I think that's probably one of the biggest mismatches out there.
So that's definitely something to keep an eye on, because obviously it's not priced in, right? That there would be, yeah. And it's also sort of difficult to determine if that would be a net benefit to the market, right? Because the market has sort of seemed to wrap its head around tariffs as is, right? So then if you got this, would it actually be positive? Would there be some negative knock-on effects to the treasury market, as you point out? I mean, how are you thinking through that?
Yeah, it's great questions, Julie. So I think that there is this sense that we're in a more stable period, and we'll take a stable period. I do think that we are going to have these tariffs regardless of how the Supreme Court rules. I do think because of where we look at the fiscal picture, if there is a sense that these tariffs are going away, does that change some of the bond market dynamics here? And probably a final thing that is important to look at here, Julie, is that the court case that's going to the Supreme Court has been a consolidated set of cases that was done by this appeals court. And so you could have easily a split decision. There are the fentanyl immigration-related tariffs. I think there's a stronger argument there that you can use emergency economic powers that were built on a national security concern and uphold those versus the reciprocal tariffs, which is what we most of the time talk about, which the courts have been much more skeptical about because there's not that same level of national security emergency that has been identified here. They have not been bounded. They don't have a structure around it. And so you go back to the last time we had some court cases back in the 1970s about it, where the court upheld a decision by Richard Nixon to do an across-the-board tariff because it was only for 6 months and because it was limited to 10%. The unbounded nature of the tariffs that President Trump has done, I think, is going to be a big question for this court.
And Ed, another flavor of the tariff story here is the other headline I mentioned, President Trump asking the EU to tariff Chinese and Indian goods, another way of sort of exerting pressure on Russia. And this coming the same day that Poland says it shot down Russian drones that had entered its airspace. So I wonder if the EU is going to be amenable to this request as a way of pressuring Russia, or if they would prefer other ways.
Yeah, so I'm going with probably not. What I've been thinking about here and what I've told clients at Raymond James all year is when it comes to the trade fight with Europe, a lot of it has been about asking Europe to pick a side. Are you with the United States? Are you with China? And so kind of it's really interesting for him to say, hey, I want you to do the tough thing on China that the United States not willing to do. We've advised clients at Raymond James that for the next several months, we expect the relationship between the United States and China to be quite good because President Trump wants to have a meeting with President Xi come November, and China stopped sending their rare earth minerals to the United States after we put tariffs on, and that almost shut down industrial capacity here in the United States on autos, on aerospace, on semiconductors. And so right now, we can't get too tough on China or that shuts off, and that's a real national security risk. So let's get someone else to do our bidding. And then as it relates to Ukraine and Russia, Trump has said, all right, Europe, if you are so concerned about what's happening here, I need you to step up and demonstrate you're willing to do something that I'm not willing to do. There's conversations in D.C. about more sanctions against Russia, but we actually haven't seen the official act just yet. Why is he asking them to do something that the United States is not willing to do right now? Is the real market question.
Yeah, really interesting one. Ed, it's great to see you as always. Lots of interesting, thought-provoking stuff to think about. Thank you.
Thanks, Julie.
Coming up, we'll be speaking with the CoreWeave CEO from the Goldman Sachs Tech Conference. Keep it right here. Welcome back to Yahoo Finance. I'm Brooke Palmer. We're live at the NASDAQ. Let's turn now to some of today's top analyst calls on Wall Street. Oracle, Nike, and Anglo American. Oracle shares soaring this morning after the company showcased accelerating demand in its Oracle Cloud Infrastructure segment, up more than 39% this morning. It expects AI-fueled cloud revenue to jump to $144 billion by fiscal year 2030. Now, that demand led to multiple analysts raising their price targets on the street this morning, including at Cantor to $400, Guggenheim to $375, and Scotiabank to $350. Now, the stock also got an upgrade from Bank of America from neutral to buy, with that price target of $368. The analyst there said, quote, the sustainability of Oracle's long-term competitive moat in the AI infrastructure industry is unclear at this point. However, the company's history as a leading software platform should translate to building value-added managed services for AI workloads over time. That stock now sitting around $336. And Nike got an upgrade from TD Cowen to buy from hold. The analyst there, John Kernan, said that he's bullish on the overall turnaround strategy at the footwear and apparel giant. He went on to say that says that new management is really executing with signs of improvement for both the Nike and Jordan brand. Now it's set to report its first quarter results on September 30th, and that stock moving just slightly higher. And shares of the mining company Anglo American moving higher this morning as well after Berenberg upgraded the stock from sell to hold. That stock up now about 3%. The company announced a merger with the Canadian mining company Teck Resources, and the bank said that the merger will unlock $800 million in group synergies. The analyst also said that today's stock movement provides a favorable tailwind. Keep it right here on Yahoo Finance. We'll be tracking all the latest market action.
Yahoo Finance continuing its coverage at the Goldman Sachs Communacopia Conference. Excited to talk to our next guest because, as far as I'm concerned, this is the AI company of the year. CoreWeave co-founder and CEO Michael Intrater. Good to see you in person for a change.
It's great to be here, and I like that, the AI company of the year. There's some stiff competition for that.
Look, I mean, like, I have NVIDIA and there's many other companies, but the AI story of the year has been CoreWeave. You had the IPO, and now you're out with a new venture fund.
Yeah.
Talk to us about it, because the market sure seems to like it.
Yeah, so the venture fund makes a ton of sense for us, right? Because it allows us to help get to know new AI companies that are being formed. It gets us into the ecosystem deeper. It allows new companies that require compute to be successful, that require compute as one of the fundamental building blocks of the next wave of technology to become available to them. And so we get to invest in them. We get to help give them access to compute. We give them, the ability to kind of build and scale and run their experiments as they begin to grow. And it's really been a tremendously successful, and we think that it is an important part of building a robust, resilient ecosystem where lots of different companies with lots of different ideas can bring and build their particular solutions and deliver them to the market.
So we've seen NVIDIA do something like this.
Yeah, it's I'd like to say we came up with the model, but it's not. It's so logical. It makes so much sense that a lot of companies are building these type of extensions because. It provides an incredible feedback loop to us also. It lets us know where we need to dedicate our resources, what we need to build. And that flywheel of them helping us and us helping them is important not just to CoreWeave, but to NVIDIA and to many, many other companies also. And us being able to put that out there to really provide an on-ramp for infrastructure for these companies and resources, it's been very successful. It's very exciting.
What do you think about some of the valuations on these AI startups?
Yeah, listen, valuations are always challenging when you have a technology that's really changing the world, right? And people have talked to me about this before, and I just think that we need to kind of really look at this from the potential of what these companies are going to do to our economy, to our society. And there's small companies that come along that begin to invest in an idea. They build that idea. They deliver the infrastructure to change the world. And so, we know there's going to be a failure rate. We know that there's going to be a success rate, and we're very, very comfortable, investing time, resources, compute to driving them forward.
I had a really fun conversation with OpenAI CFO Sarah Fryer, and she said this year, their sales for their business will 3x or increase 3 times versus last year to $14 billion. You have a relationship with this company.
Absolutely.
How much business will you do with OpenAI this year, and can you do more?
Yeah, so earlier this year, we announced an $11, $12 billion contract with OpenAI, which is a massive scaled contract, yeah, and just defining for a massive facility. The answer to your question is, and this is not a commentary on CoreWeave. This is really a commentary on the infrastructure space that's trying to build the computing requirements for all of these AI labs. The space is. The depth of the demand, the scale of the demand, the breadth of the demand is overwhelming the industry's capacity to deliver the compute that is required by OpenAI, by the hyperscalers, by the enterprise, by the sovereigns. It's just layer after layer of overwhelming demand. And so we're building as fast as we can. We're building as large as we can. We're delivering as many GPUs as we can. On the one hand, I've got Sarah yelling at me. On the other hand, I've got Jensen yelling at me. And we're driving through the middle to try and get this infrastructure into the hands of these incredible companies that really have the capacity to allow artificial intelligence to achieve its potential. But they can only do that if we can deliver the compute, right? The compute defines the limit of what can be built.
Will there ever be enough compute?
So
I put that question to Sarah.
Yeah.
But I'm curious on what.
So look, I'm a market operator. I've been a market operator my whole career, right? Like markets are very good at solving for efficiency, bringing supply and demand into alignment. And so, yes, of course, at some point there will be enough compute. However, when and what that looks like is a point of discussion, right? And it's a point of discussion where I think it's really necessary, and I encourage my team to kind of think about it in the forest versus the trees, right? We're going through a global build out of the computing infrastructure for artificial intelligence, which will define the economy, which will define society for the next 100 years. That's the forest. And so when you think about it from that lens, it's unbelievable how much needs to be done to support globally what is required for this technology to ultimately provide the benefits that it's capable of across medicine, across energy, across the economy. It's just like astounding how many different ways it's going to impact it. The trees are, there are going to be signals periodically that are going to say, oh, there's enough, or and like I just think that we got to zoom out. And when you zoom out and you look at the scale of what needs to be built, we are in a super cycle that's going to last a long time as we continue to build and deliver this infrastructure to the world.
Not so many people get to work alongside or see how a visionary in an NVIDIA CEO, Jensen Huang, operates. What have you learned from him as you've scaled up your business?
So look, Jensen has been a tremendous supporter of our company. And, I think the world thinks about him from a, he's building this great technology. But one of the things that has been so interesting is to see the breadth of the aperture that he uses to understand where we are, where the technology is going, and what he needs to do in order to make it successful. And I think it's really important as a CEO to be able to zoom out and see the world that way, because there are so many moving pieces that are required to drive a business of the size and scale that he runs. And his capacity to do that is unmatched.
Yeah. It's been phenomenal to watch his journey, and we'll continue to follow yours. CoreWeave co-founder and CEO Michael Intrater, good to see you.
The ETF industry, of course, has been gaining on mutual funds for years now, and a new ETF is aimed squarely at what its creator says are the continuing inefficiencies of the mutual fund structure. Let's bring in Joseph Shaposhnik, Rainwater Equity founder and portfolio manager for this week's ETF report, brought to you by Invesco QQQ. Joseph, I'm curious to get your take on the broader market, but I do want to start with your ETF. It's called Rainwater Equity. And, obviously there's been this sort of tension in the business for a while, right, between mutual funds and ETFs. ETFs have gained a lot of market share. They're still not quite the size of the mutual fund industry. What do you think still needed to be sort of corrected for in the mutual fund structure that you saw an opportunity in the ETF world?
Well, I would just step back and say the opportunity is the inefficiency with which most fund managers manage their funds, or the whole concept of fund management. The concept is, for most managers, they look at a benchmark and they believe they have to make a decision or have an opinion on each constituent in the benchmark, as opposed to just investing in what they believe they can predict. We think that approach doesn't work. So our approach is entirely focused on investing in what we think we can predict, which is recurring revenue businesses, or businesses that have contracted revenue associated with their business models. Now, you asked about the ETF structure itself. Clearly, it has huge advantages. The tax efficiency of the structure, while it's talked about a lot, I think is still underappreciated. We looked at data which said that on average, mutual fund investors lose almost 2 percentage points a year in tax drag from being invested in a mutual fund because of the inefficiencies associated with the mutual fund. So the structure itself is not as attractive as the ETF because of what you can do with it. And of course, there's the transparency associated, transparency benefits and intraday trading ability of the ETF. But from our perspective, we believe the inefficiency is the strategy behind the investment approach, which is focused on investing against the benchmark as opposed to investing in what we think somebody can predict.
And so somebody can predict, to your point, the recurring revenue piece of this. Specifically, that's what you guys are looking at. So what kind of companies are we talking about here? Are we talking about particular verticals? Are we talking about just sort of on a case-by-case basis? How do you determine that?
Well, we're really looking at businesses that have contracted revenue. So that's business that is contracted on a subscription basis. So that can be software, that can be interactive entertainment, that can be services as well. So we own software businesses, we own waste management businesses, we own stock exchanges, and stock exchanges have contracted revenue associated with them. The listings typically are contracted. And then there's a portion of the business which is what we would call transactional recurring revenue, which is activity associated with trading that occurs on a stock exchange. Those are the kinds of businesses that we own in the portfolio. I mean, one of the big things that got our attention is looking at management teams and their ability to forecast their businesses. Today, NVIDIA has been a phenomenal stock, but if you went back to 2022, the stock went down 50%, and management sold $3 or $4 billion worth of stock 1 year before the stock went up tenfold. So even the smartest management teams on earth, even they have trouble forecasting these non-recurring types of businesses. And so that gives us even more confidence that we're onto something with regard to investing in recurring revenue businesses.
Well, I mean, just by the same token, you could say, speaking of ETFs, I'll just buy the SPY, right? I'll just buy the QQQs. We're at record highs. That's worked pretty well. You know, I guess in this environment in particular, what's the argument for investing in these types of companies?
I think the argument is that the SPY has been great, but it is more concentrated, it is more expensive than it's been almost at any other time in its history. So the stocks have been phenomenal stocks. And what we do, which is special, is we're giving investors access to a portfolio that is far different than the SPY and more active because it's different, and access to a manager that has a 10-year record of outperforming the broad market, which is pretty unusual because the SPY has been so difficult to outperform, as you talked about.
Yeah. Joseph, thank you so much for joining us. We appreciate it.
My pleasure.
Coming up, we got full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Coming up this hour on Market Catalyst. First up, Oracle reignites the AI trade on Wall Street, but are valuations frothy? Plus, we'll zero in on the state of buy now, pay later as Klarna gears up for its public debut. And we get the latest read on the state of the labor market as new revisions paint a murky picture for the U.S. economy. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets here as we watch the major averages pushing towards records, at least for the S&P and the NASDAQ, both of them trading on that basis, on a closing basis, but the Dow pulling back a little bit today, 244 points, about 0.5%. The AI rally is continuing to push markets to new records with enthusiasm renewed after a strong forecast from Oracle. My next guest, though, warns he's seeing some frothiness in the market and that there are some risks ahead for AI. Here with more, Tom Sosnoff, tastylive founder and CEO. Hey, Tom, good to see you.
Hey, Julie, good.
You know, we keep having this frothiness discussion sort of back and forth, right? And lo and behold, the markets keep pushing up to new highs. So where do you see the frothiness and how could that play out?
I mean, at first, if you would ask me this question a couple of weeks ago, I would say the frothiness was, more in the IPOs, kind of crypto marketplace, some of the meme stock type things. Now I think you're even seeing it. I mean, you take a look at the overnight move in Oracle right now. That's a frothy move. I mean, you don't get a 4 standard deviation move just in kind of a normal marketplace, no matter how good somebody's earnings are. So I think you're seeing things are getting overdone, in some cases overdone in both directions, but I think all of it is, a case for frothiness.
Tom, I'm curious about the source of the frothiness, right? It used to be that, it's easy money, rates are low, during the pandemic, it was people are getting checks, they're putting them in the market. Where is it coming from now? Where is this demand coming from?
Well, there's a lot of money out there. And I know that sounds kind of crazy, but there's been an incredible amount of wealth. Like when you start to think about how much wealth has been created in this bull market and how that money just kind of, it rotates around from sector to sector and from stock to stock. Like just even today, you can see, with Apple and Amazon and Meta down, that money just rotates into somewhere else, whatever's hot. There's just an incredible amount of money around, and there's not that many new stocks and that many new places to go. I mean, bonds are pretty fully priced at this level. So, I think that's where the money comes from. It's just kind of a rotation, and there's just a lot of money out there.
And as you pointed out, you thought that the previous sort of move here upward, some of it was going into crypto, some of it was going to meme stocks. Yeah. I mean, I know I always ask you about GameStop, but that stock's higher today after it came out with its numbers and effectively has become another crypto treasury company, right?
Right.
What do you think of that trend and what it says about that sort of frothiness?
That is another red flag to me. So, I mean, just the craziness in the IPO market, the craziness in what we saw like today, just on an earnings play, and some of the craziness in just in some of the, blind index buying, that's all interesting. But when you get into this kind of the micro strategy, crypto space where, GameStop's kind of like a kind of a cheap imitation, you start to wonder, okay, how crazy is it that people are willing to put money into an idea which is essentially a convertible bond with not paying any interest and not giving you a conversion rate, and basically trading at 1.5 or 1.75 times the value of the crypto that they're buying? None of that model makes sense to me. So I've been dying for somebody to explain it, but so far I haven't heard a reasonable answer. So I think it's a combination of all that.
And so you've been in this game a long time, Tom. So
longer than anybody else alive.
So that these things can end badly, but they can also last a really long time, right?
Sure, of course.
So What would be sort of your contenders to pop this bubble, if it is a bubble, or to bring, take some froth out?
So, the great thing about trading, and one of the reasons I've probably been around for so long, is that the answer to that question, if any of us had a clue, we would have been long gone.
Yeah.
Meaning that, because you could have just made so much money. I think it's never what you think it could be. In this case, I kind of feel like it may be when the Fed actually starts to lower rates, that may be kind of the nail in the coffin for the markets. But I don't know. I mean, we haven't seen any selling, and usually it's something that we don't expect. So I don't know the answer.
Well, and there's been a lot of things this year that we haven't expected, and the market has just kept going up on the flip side of things, right?
Yeah, the market's been, except for April, 2025 has been relentless. April was a pretty good scare, and the whole tariff, stuff was a pretty good scare. But other than that, this market has been relentless. It's pretty much been relentless for the last 2 years. And so, you've got virtually every index, hovering around. I don't know if this is a new high in the S&Ps today.
Yeah.
If not, it's super close. And, you've got everything at record highs. It's hard to, it's hard to be anything but, hey, I'm not going to do anything other than buy them until they show me something different.
Well, and Tom, is there anything in this market that does make more sense to you, that is more rational or even attractive?
until the last week, I really thought the bond market, both the bonds and the notes, were super attractive because I thought that they were cheap relative, very cheap relative to stocks. Now, when I look at the stock market, I don't think there's even a single commodity out there that looks cheap to me. So not only is the stock market expensive, the commodity markets are expensive, and I don't even think the bond market's cheap anymore. So unfortunately, I don't think there's a quote safe haven right now, a risk safe haven, a risk on safe haven. Maybe I'm wrong. I'm wrong a lot, but there's not a marketplace right now where I think, oh, hey, this is cheap. If we get a little bit of a sell-off, I think you will get some things that get overdone relatively quickly, just because of the way today everybody piles on in one direction or the other.
Yeah, definitely a feeling of like going to one side of the boat and then going to the other side of the boat.
Yeah, there's nobody sits in the middle anymore, Julie. Everybody's always they're either all in or all out.
Yeah, no fulcrum whatsoever. Tom, thank you so much. It's always great to talk to you.
Thanks so much.
Coming up next, we're going to talk to the CEO of a buy now, pay later company, not the one going public today. It's called Zip, and it's about how the sector is shifting from luxuries to essentials. Stay tuned. You're watching Market Catalysts. Klarna, the buy now, pay later company, raising nearly $1.4 billion in its initial public offering that was 25 times oversubscribed. It's a positive sign for the industry, but are some players more effectively navigating the buy now, pay later market than competitors? I'm joined by Joe Heck, Zip US CEO. Zip is a buy now, pay later firm that is seeing growth led by non-discretionary items like groceries, healthcare, education, and bills. Thanks for being here, Joe.
Great to be here. Thanks for having me.
So let's talk about the different approaches that sort of different BNPL companies take here. So how would you say Zip is sort of distinguished from some of your competitors?
Zip really focuses on what we consider the underestimated American. They're largely disenfranchised with the traditional financial system. You know, the typical financial products are hard and complicated for, I would say, everyday Americans to navigate. And I think what we've done uniquely is we meet that customer where they're at, and we really meet them with a simple product that's easy to understand and simple to pay back.
And so does that mean that folks are not sort of using your product as much for discretionary purchases? It is more sort of an essentials item?
Absolutely. And I think if you look at the kind of everyday spend of an American, you know, if you don't have access to what I would consider credit privileged products, you know, just everyday items in between choppy cash flow can be problematic. Where Zip meets the customer, especially on those non-discretionary items, is we offer that kind of working capital, if you will, that allows them to kind of navigate the in-between of the inconsistent paychecks of an everyday paycheck to paycheck consumer.
So I guess the question is, Joe, I mean, you look at how BNPL is expanding here in the United States, and you can use it for almost anything, right? And in some cases, you can use it to buy coffee, not just here, but in other places too. You can use it to buy small items. Do you think that there's a risk in that kind of strategy?
There can be a risk. I would certainly acknowledge that. But I would also say there's a risk with any credit facility. And you look at most Americans, you know, we buy coffee with our credit card, and we take advantage of a 30-day float. You know, I think what is really important is meeting the consumer and basically meeting them with a product they understand and allowing them the right payback opportunity. So specifically on smaller purchases, you know, stretching those out over 6 weeks may not be the right option. We are in the midst of pushing forward a pay in 2 product that really simplifies those smaller purchases, brings a fee structure down to a reasonable place. But it allows that same customer to use what all of us are probably pretty accustomed to, which is a nice 30-day float on a credit card. And really this just becomes an alternative vehicle that provides that working capital for that everyday American.
Joe, do you see the U.S. market as big enough for all of these various players? I mean, what do you see as the sort of total addressable market here? And do you see the existing players sort of operating in their own lanes, if you will? Do you see market consolidation? I mean, how do you see the market developing here?
Look, it's a big market, and I would say the U.S. is still in the early days. If you contrast the U.S. to other more mature markets, U.S. is at 2 to 3% of total commerce here that are using BNPL. About 6% of e-commerce, and contrast that to like Australia, you're in the 15% range. I think there's areas in Europe that are closer to 20. So I would still say there's this familiarity with the product that we're still in the early days on. So we look at the addressable market as over 100 million U.S. consumers could benefit from this simplified product structure. And for Zip customers, that doesn't even really get into any potential cannibalization of credit cards, which I think you're seeing that becomes really attractive in this next generation that's really trying to avoid debt and avoid kind of the revolving potential debt trap that they can get caught in a credit card.
Do you think, though, as we, there are some sort of weaknesses, right, in the U.S. economy, particularly with low-income consumers that you all are seeing as your main audience? We just got a jobs report that was quite alarming to some economists. So do you see default rates and delinquency rates going up for BNPL?
We really focus on our customer, meeting them where they're at. These are small dollar loans that we find really good data in our own. So if you can imagine our product, we find repayment behavior every 2 weeks. So we get real-time data, and we're constantly adjusting and adapting to the consumer. So while certainly the jobs data wasn't anything anyone's excited about, I think people are continuing to work and hustle and pay off their bills. We get over 98% payback, and that continues to be a strength of us, really partnering with our customer base and partnering with our merchants.
And Joe, I want to ask you, on this day where we're waiting for Klarna to start trading, there was big demand for the IPO. It looks like the stock's going to open well above that IPO price. You guys are talking about dual listing. You're listed right now in Australia. Is that because you see that there is an appetite, an investor appetite for these kinds of equities?
Congratulations to the Klarna team, for sure. It's a big day. We look at the market very similarly. We've been really successful here in the U.S., over 100 million in cash earnings in FY25, and it's now 80% of our global earnings. And so looking at the U.S., we have plenty of U.S. investors in our current register. And one of the things that this really potentially provides us an opportunity with is to open ourselves up to the broader U.S. capital. And about 16% of our register right now is foreign, but given the dominance of the U.S. business, that ability to provide access to U.S. investors that can't access on the ASX is really important. But also there's other really quality reasons as we look at just investing in our own company and our employees. Having a U.S. currency can be really valuable as we continue to grow this company aggressively in the U.S.
And Joe, any idea of timing as to when you guys might do it or make the decision?
We're still in the exploratory phase. As you can probably imagine, there's a lot of work that goes into this. It will require our board approval at some point in the future. So we'll continue to explore the option, and as we solidify that, we'll be more clear with the market.
Fair enough. Joe, thanks so much. Appreciate it.
Yeah, thanks for having me.
And as for Klarna, you can tune into Asking for a Trend today at 4:30 p.m. Eastern for an interview with Klarna CEO Sebastian Siemiatkowski. He'll be joining my colleague Josh Lipton later today. And Yahoo Finance executive editor Brian Sozzi spoke to the leader of another big player in the buy now, pay later space, Affirm CEO Max Levchin.
Now you're here with a point, not if you didn't need the validation, but you got it anyway. Operating profits. You've been telling me for 2 years we're going to hit it this quarter. And you hit it.
You are the only one who remembers. Like
I remember.
Most common question from investors after this quarter, how'd you do it? Like, we literally pre-announced it 2 years ago and 1 year ago on the date saying, give us 24 months, 12 months operating profit. Like,
None of these folks are watching Yahoo Finance. They really need to
they
seal your interviews.
Best interviewer ever.
Thank you. So how did you do it?
With a lot of planning and careful execution going back many years, yeah, of course.
Is it more a function of the top line than anything you may be doing on the expense line?
So years ago, like literally years ago, I dropped this very, very simple formula for a firm. Basically said, hey, here's how we get profitable. We need more reach, so more people, more frequency, more transactions per person, times positive unit economics. Can't lose money in every transaction. You will never make it up in volume. So if you have positive units, growth of user base, which has to be coming from growth of merchant base, of course, frequency increasing, both through the network effect of just more places to use a firm and customer satisfaction where consumers are saying, that was great, I'll do it again. Those three things multiplying, at some point, that will be such a large number, it will exceed whatever costs we have on human capital, hosting, underwriting data, et cetera, and sure enough, because the math is really simple, we could see those two lines intersecting fairly far in advance and said, hey, 12 months from now, GAAP profitable, and here we are.
What's your next prediction then?
We're going to keep doing this for a long time.
So you're staying profitable. Now you've entered that
We're definitely, the thing that was, the math I just described is in fact the right way of thinking about the company, and we have been. The thing that's been addictive, which I didn't anticipate, is the operating leverage. So as we grew the top line and the bottom line, we saw just more and more revenue coming from roughly the same number of people. And so we'll continue being profitable, and I quite like being able to show up to the market and say, we can keep doing this without the growth of headcount and other parts of the cost matching the growth of top line. So expect more.
I think every year that I've talked to you, here at least, a firm has seen, I've seen a different version of a firm. And I just don't think it's not buy now, pay later anymore. It's like you created a whole ecosystem of other stuff, Max.
We call it a network. It's a network.
Stuff.
Yeah. A year ago, in this chair, I said we're going to be the next Amex, and we're 1 year closer to it. And Amex is much more than lending, much more than credit cards or charge cards. It's a network. Most importantly, for them and for us, and we try very, very hard to live up to this claim, we stand for an experience. We stand for being treated the right way for both the merchant and the consumer, for the lack of asterisk. Every company in finance, very, very few exceptions, unlike us, have this notion of, well, zero is not really a zero because there's a fine print, you got to read the fine print. One of our core values is no fine print. We mean you will get what you see. And building on that core has allowed us to build an ecosystem and a network and something that stands for consumer experience and a merchant experience that really doesn't just drive more sales, it leaves people feeling great about the entire journey from deciding to buy all the way to paying their bills.
How is AI changing the complexion of what a firm does?
We think about AI in three very distinct ways, and so it's probably worth breaking it out separately. So we've always been AI ML company. From inception, the sort of the core idea was, can we build a fee-free, gimmick-free, yuck-free lender by using better math? And for that, you have to use some pretty serious stuff. And so ML and AI was the thing that we brought to market. And sure enough, it's hard to be profitable, they say, without late fees. And here we are, proving the exact opposite. So that's been our thing for a very long time, and we keep on building models, and we have all sorts of really exciting stuff that we're doing at the very cutting edge, sort of what they call frontier models, and just classical ML as well. Beyond that, there is an enormous opportunity in productivity. Part of how we got to this amazing operating leverage, posting quarter after quarter, more revenue, more growth, roughly the same number of people, is by strategically deploying AI tooling to not just our engineers, but our lawyers, our compliance folks, our HR. So every part of the company was asked and is enthusiastically looking at its work process and answering the question with, we can do more with fewer people because the tools are just getting better and better. And so that's been a giant driver of productivity for us. And it's pragmatic. We're not going to fire a bunch of people and then have to rehire them because AI is not ready yet. But it is ready for some things, and they're quite awesome. And then AI is an opportunity driver. The thing that's coming next in shopping is this idea of agentic shopping, where you tell your LLM, hey, could you please compare prices for me? Can you track a deal? Can you find out when something goes on sale and let me know? Those transactions will complete inside of an entirely new paradigm. So it'll be inside your LLM, your chatbot, that is both your shopping assistant, potentially your wallet, maybe even your browser. That's another way for a firm to play a role. Our competitive advantage, so the moat of a firm, is this giant book of these 0% or reduced APR offers, like the truly unique consumer offers that merchants pay for to compel someone to go from being a shopper to becoming a buyer. That works just as well inside of an LLM, except the LLM is going to be smart enough to say, the 0% offer from a firm is the real deal. The 0% with an asterisk, don't touch that. That's going to bite you, because if you're a penny short or a day late, it's going to charge you full load of interest. And so I'm actually quite excited about the financial education aspect of LLM shopping, simply because what we stand for will become that much more fundamentally valuable.
Who do you view as your biggest competitor? Is it American Express, or is it a company called Klarna that may IPO this week?
Neither, to be honest. I think all of us are trying to replace revolving interest issuing cards. There's plenty of card issuing banks that frankly sell a product they're not proud of, that they give to people because they don't know better, because they don't read the fine print, because they need access to credit and they can figure it out later, but of course it's the sort of thing that you can't undo. That's the goal. Like right now we're still on the order of basis points of the overall credit card spend. All of us, public and private, are just trying to take some of that revolving debt and bring it to BNPL, which is simple interest, in our case, no fees of any kind, obvious schedule, obvious disclosures, just a better consumer product. So for the moment, I primarily ask myself, how much road is there to take from the traditional credit card issuers? And it rounds up to infinite.
Is your competition with a Klarna the same as Coke and Pepsi? Like, is that intense? Because Max, I see a firm, I compare it to Klarna, and I almost think they're two different companies.
They are, and therefore, I think you answered your own question. We have our goals, they have theirs. We have our opportunities, and I think it's very hard for me to know what they will do and how they'll do it. I'm very confident I know what we'll do and what we stand for. Our value proposition is fundamentally about the experience that the consumer has, the loyalty that engenders, the fact that the merchants get an incredible deal that they have to offer at a lower cost than discounting, which is a great financial proposition for them. And most importantly, that after the whole thing is over, the consumer says, that was really great. I was maybe a day late and they sent me a nice reminder, didn't charge me a penny more. I should do that again.
Welcome back to Yahoo Finance. I'm Britt Tamama. We're live at the NASDAQ. Let's get a quick check on the latest market action. We're about 2 hours into today's trading session, and we're seeing a bit of a mixed picture on the street right now, with the Dow moving lower and the S&P 500 moving higher. Really, this tech rally returning as the NASDAQ jumped about 0.5%. Now we're seeing just a bit of a pullback, up about 0.3%. The S&P 500 also seeing that similar momentum, that index up about 0.4%. And we also got year-end target raises for what exactly the S&P 500 could hit by year-end. Deutsche Bank saying that it could hit as much as 7,000, and Barclays also raising their outlook as well. In addition to that, we are seeing the Dow, which is less tech-heavy, move lower this morning, down about 0.6%. But I do want to get to that top trending ticker on Yahoo Finance that is holding onto the momentum in the morning trading session here. Oracle up about 40% today alone. And year to date, this stock continues to prove itself up over 100% year to date after that AI revenue outlook really impressed the street. And that's why we're seeing the upward momentum this morning. I also do want to point out to the commodities market, gold futures. Right now, we're seeing gold futures moving just a tad higher, up about 0.07%. But year to date, gold has had quite the run June, we got that wholesale inflation that declined for the first time since April, and that's really baking in rate cuts. We also see gold really rising on rate cut expectations out next week. And I also want to take a look, as year to date, gold is soaring up about 40%. When you take a look at the sectors, that actually outpaces what we're seeing year to date from both communications, up about 20%, what we're seeing there, and also outpaces the rise year to date that we're seeing in tech as well, up about 16.5%. But keep it right here on Yahoo Finance. We'll be tracking all the latest market moves. Once again, all three major indices a bit mixed right now.
Now time for some of today's trending tickers. We are watching Oracle, Apple, and Potbelly. First up, we got Oracle with the stock nearing $1 trillion in value. It has taken its founder, Larry Ellison's wealth higher than that of Elon Musk. Joining me for more, Yahoo Finance's Ali Canal. So the share is now up 41%.
Yeah.
It's a record one-day gain. And so, record one-day gain, I guess, for Larry Ellison's wealth, likely as well.
Exactly. He has a 41% stake. It's now nearing $400 billion. That overtakes Elon Musk's net worth of just around $384 billion. Now, Elon Musk, that's been hit by the Tesla share decline that we've seen really throughout the course of the year, especially after his uncoupling with President Trump. That stock saw a bit of volatility. But, I mean, this Oracle move just really encapsulates what we've been talking about when it comes to the future of the S&P 500 and what could lead the gains, lead the rally. Brick was just mentioning some of those S&P target increases. And across the board, whether you look at Barclays, Deutsche Bank, Wells Fargo, they all mention AI. They all mention that CapEx spend. And it's really the offshoots of AI too, all these software companies that are now benefiting from this aggressive spending that we've seen across the board here.
Yeah, I mean, I'm also interested, like, I find Larry Ellison a fascinating figure, right? And this is a guy who's been known as a really rich guy for a really long time. I mean, he's 80, so that in comparison with Musk, who's in his 50s, right? So he owns a bunch of Hawaii, right? He's known as being a guy who is extremely wealthy and who is not afraid to spend that money around.
And his son.
Yes, who has now intersected with your normal universe.
Yes,
David Ellison.
David Ellison, Skydance Media acquired Paramount. Now we have Paramount Skydance, and I believe Oracle is an investor, or his father is some sort of an investor.
Yes, I seem to recall that.
In this deal. So yes, just a lot of different industries now that the Ellison family has their hands in.
Yeah, exactly. All right, let's talk about another mover here. Apple. Shares of the iPhone maker sliding after its product event fell short, at least according to what some analysts were seeing. Now, I saw a lot of talk, Ali, about the new iPhone Air, which everybody said is really cool, it's really thin, but nobody really needs, like, in other words, that most of the reviews I saw said the newer versions of the iPhone 17 are much more useful than the Air.
Yeah, I think that's what people want. They want the capabilities to shoot better pictures. They want to have sharper images. They want maybe even some AI use cases, which we know that Apple, compared to a lot of the other tech players, has been a bit behind with, and that's part of the reason why we've seen shares struggle. So it just doesn't seem like this was this revolutionary Apple event that we've been used to in the past, and that's why you're seeing shares down today around 3%. Just that disappointment there. And there's also the consumer question within this current environment, how much they will spend on some of these maybe more discretionary purchases when it comes to upgrading their phones. I mean, my phone, I'm very ashamed to say, it is cracked all over the place. I can't even take this case off, but it works fine. Do I necessarily need to spend a lot of money to purchase a new phone? And I'm a little nervous with how thin the iPhone Air is. Does that mean it's going to break more than the other phones? Is it a little bit
I
more
don't know.
indestructible?
I haven't read as much about the durability of it.
Yes.
But I mean, basically, the phone is now more of a utility than a cool gadget, right? And unless Apple has something more, sort of that moves the needle more, it seems hard to see what Yeah. What change? Those Apple events of yore that you refer to, like those feel pretty far in the past.
It's not the cultural event that it once was.
Definitely not.
If you're unveiling a new iPhone, the upgrade cycle, it doesn't carry as much weight, especially when you have AI just dominating the conversation.
For sure. And finally, very far from the phone, Potbelly. Those shares are surging after Racetrack, which is a privately held convenience retailer, agreed to buy the sandwich and salad chain in an all-cash transaction for $17.12 a share. So those shares are surging today.
Yeah, we're seeing that reaction for Potbelly, and this has really been framed as a win-win here. Racetrack is an Atlanta-based, family-owned convenience store. They operate 800 plus locations across 14 states. It previously acquired Gulf Oil in 2023. So I'm from the Philly area, so this reminds me of a Wawa play, so a little bit more niche there. But for Racetrack, this deepens its expansion into food services. And then for Potbelly, it's a chance for this company to really scale beyond its current footprint. A big presence in Chicago, around 500 U.S. shops, mix of company-owned and franchise, but the long-term goal is 2,000 locations. So it seems like that's their play to try and expand their footprint. Now they're under this deep-pocketed, fast-growing operator. So we'll see where this leads Potbelly, but you are seeing that reaction in shares. So investors, at least right now, are happy about this.
Yeah, and the shares, we should say, they hit their prior peak in early 2024, and then they have been kind of languishing over the past year. They haven't sort of managed to break out again, but today they've broken out and then some.
Right, and that's what the CEO said, that this is a good thing for shareholders. And with the 30% pop, I would say so as well.
Yeah, not bad. All right, thanks so much, Allie. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up, we got a stocks in translation for you. Stay tuned.
NVIDIA CEO Jensen Huang recently talked about the U.S. tech stack and how it compares to China's. He even threw in the U.S. dollar in the same breath, which caught the eye of President Trump. If you're scratching your head wondering what is this tech stack, sit back, because today on Stocks in Translation, we're going to break that down for you. Now, first, let's take a listen to what Jensen himself had to say to Yahoo Finance after NVIDIA's recent earnings.
The American tech stack should be the world standard. Just as the American dollar is the world standard that economies are built on, we want the American tech stack for the world's technology and industries to be built on. And that includes China.
Now let's define this term. In tech, a stack is already a metaphor, a layered view of how the parts of technology work together. For AI, you can think of it as a hierarchy or a stack with hardware at the bottom all the way up to the apps you use at the top. And here's how it breaks down by layer. We have applications at the very top. That's chatbots, design apps, and company tools people actually use and touch. Below that are platforms, the basic software tools used to build and run those apps. Then comes the infrastructure, which is the cloud and data centers, big facilities running services and AI. And on top of all of that, it's built on the hardware layer. That's chips, servers, and the equipment that connects them. So how does the tech stack compare to China? In this chart, we have each bar is a country with the US at the left and the China at the right here. Each color is a different layer of the stack, and it's in the same order as before. We had to make a lot of assumptions to get these numbers, so take them with a grain of salt. And what we're attempting to measure or estimate is the annual flow of revenue or sales for the hardware and software items. And for infrastructure, by the way, we're using capital spending instead of sales. The devil's in the details, as they say, but when you add it all up, it's easy to see that the hardware layer alone in the US, that's in the bottom in white, that is larger than the value of China's entire stack. And it all totals to about $725 billion annually in the US, compared to about $125 billion worth for China. So why bring up the business of the US dollar dominance? Because the dollar is the world's reserve currency, which is a widely held national currency used to trade, borrow, and save across borders. Reserve status means it's trusted, easy to move, and accepted everywhere. And now we can compare how widely the US dollar is held versus the Chinese yuan, its currency. If you add it all up, the world's currencies held by all the central banks, it comes out to the equivalent of over $12 trillion. And the US dollar share of that is just under $7 trillion, which means that the dollar makes up about 60% of the pie worldwide. And that compares to about $250 billion for China, or just under 2%. And getting back to Huang's original point, we can now compare US tech stack dominance to that of the US dollar. Here we have these two worlds side by side. The US tech stack is about 6 times as big as China's, so that ratio is 6 to 1. Meanwhile, the dollar's holdings are about 25 times that of the Chinese yuan, so that's a 25 to 1 ratio. In other words, the dollar is much more dominant than the US tech stack. And just to be clear, this is a very apples to oranges comparison. But the whole purpose of this exercise is to view the global AI race from the perspective of the leaders that are shaping it, not only on the tech side of AI, but also on the government policy side. It's also an interesting way to think about relative scale. And the bottom line is, think of the tech stack as today's competition for global standards, like the dollar in finance. The US leads it for now, but the race is definitely on. And tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcast. Stay tuned for more market catalysts.
New data shows the labor market softening with more job seekers than open roles for the first time since 2021. And it's even worse for new grads. New data from Indeed shows job postings for junior roles are down 21% compared to pre-pandemic levels. Joining me now to talk about all of this, Jennifer Harity, Indeed career trends expert. Jennifer, thanks for being here. So we have that figure that's pretty alarming about postings for new grads. We see it reflected in the unemployment data for young people as well here. What's going on there?
Yeah, I mean, so what we can really see in the data is that there are feelings of uncertainty. And of course, when you look at those data points, you can really see why. You know, like you said, many job seekers are finding the current job market to be increasingly competitive because of these figures, right? You know, there are more job seekers than there are open jobs. And of course, like you said, 21%. Roles are down 21% compared to pre-pandemic levels for those entry roles. So recent grads are entering into a uniquely challenging job market, and many are feeling unsure about where they fit. And there's some recent data that shows what this uncertainty is really showing up as. You know, we see that 42% of new grads are hesitant to apply for jobs, and of course that number is increasing, with 58% among Gen Z. And we also see that uncertainty reflected in how, you know, currently employed job seekers are feeling. We see that more than half are feeling stuck in their current career, and 79% wish that they knew what jobs match their skills. So, you know, within this data, we really see that reflected in how job seekers are reporting that they're feeling, you know, in relation to it.
Do you get a sense as well from employers why, you know, this is happening? Are they not hiring as much overall, and that's why junior positions are affected? Is some of that getting replaced by AI? I mean, what are some of the core reasons?
Sure. So there are certain industries and certain sectors of the job market that are still doing really well and seeing growth. Those are going to be areas like construction, private education, healthcare, and even the social assistance sector, subsector. But of course, there are the ones that have recently been experiencing layoffs and really felt the impact of AI. So those are going to be roles like tech. So it really just depends on where these job seekers and recent grads are entering the market at, and you know what their skill set is. So while there are definitely sectors that have felt the impact of layoff of AI more than others, there are definitely sectors that are still seeing that growth.
For the people who are feeling uncertain, I mean, I'm surprised of the thing about people being uncertain to whether to apply for roles. You would think they would just be like flooding the zone if they're having trouble. So what do you tell people if they're trying to figure out what could be a good fit for me? Where are there the opportunities?
Right. So this is actually a really interesting place in which people can leverage AI, because there are some really great tools available that will help job seekers even identify what those are. In the data, there are 52% of those surveyed that said that they're using it to search. And when we look at tools like one that Indeed has, which is Career Scout. This is a really great tool to help you just identify what opportunities could be available to you, because this acts like a personalized career coach for you. So for anybody that's entering the job market now, really the best strategy is adaptability, regardless of what stage in the career you're in. So I would always recommend that you use AI tools to your advantage. Highlight the results that you've delivered in your application materials and really focus on skills that AI cannot replace. And these are going to be skills like creativity, communication, and leadership. So whether you're a new grad or mid-career, you want to keep building experience and stay open to roles that are going to move you forward.
Something I'm curious about, Jennifer, and this isn't just when looking for jobs, this applies to a number of different things. So say you're using AI to, say, spruce up your resume or help you look for a job. When you're in that interview, it's just you and the interviewer, right? You don't have that AI, but are there ways of using it to maybe prep, for example?
Yeah, absolutely. So 48% of people surveyed say that they're already using it to prep for interviews. And when you have tools like Career Scout that are actually built into the mobile app like Indeed, you can actually use it to prep for interviews for the jobs that you've already applied for. So really great prompts to ask AI are going to be, what are the most common interview questions? Overall, just preparing for behavioral-based interview questions, I recommend that everybody have a very strong answer to tell me about yourself, because more often than not, it's the very first question you're going to be asked in an interview, and it can set it off to where you're feeling very confident because you've answered, talking about yourself in a professional way, very confidently and concisely, but also drilling down a little bit more. We see that job seekers can sometimes be skeptical about AI because they feel like it doesn't necessarily understand their industry. And so this is where I would challenge job seekers to actually try it. Use it to prep and identify what are those common questions that you might be asked, not just for a role in general, but you can also update and upload a particular job description and ask it to provide sample questions that you might prepare for related to that specific role. So it really does give you the opportunity to prepare in a way that's going to really help you when you get to that interview.
Jennifer, thanks so much. Appreciate it.
Yes, thank you.
That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. We got more Yahoo Finance coming up.